The first thing I'd say is like your existing LPs are amazing until one of two things happen. You grow out of them or they're no longer liquid. The same person that invests in their, friend's deal when it's the only one that they see doesn't really know how to decipher between deal 1 and deal 50.
In GP Match, where do you see that this is going? Where are you working on now? What are you most excited about?
The problem is...
This is the Real Asset Intelligence Podcast with your host, Derek Barker, sponsored by Nectar. Access your trapped liquidity today at usenectar.com.
Today, my guest is Aleksey, who, before he was 35, was underwriting for Store Capital's $10 billion real estate portfolio. Then he walked away to build GP LP Match and write LP Lessons, where he now teaches more than 10,000 investors how to actually evaluate a deal and has quietly routed over $4 billion of deals to LPs without charging either side a dime. He's also one of the most honest voices in the whole business about stuff nobody talks about, like capital calls, sponsor distress, and the moment the incentives between GP and investors start to come apart. Aleksey, thank you for joining us.
Thanks so much for having me. I appreciate it.
I'd love to start out with just, I gave you a high-level intro, but you mind going a little bit deeper? How did you get into the business and what's your journey been to date?
Yeah, I think as you noted, started on the more institutional side. Was honestly like a little bit oblivious to what happens outside of the institutional world. I think you kind of get used to large purchase prices, securitizations, being able to like raise money on the stock market through like the ATM program, having a $2 billion revolver, so like it's just a totally different world. And I left that world, I guess now, crazy to say, but I guess 4 years ago, a little over 4 years ago, to start building in the private space because a few reasons. One, I wanted to bet on myself. I just realized how large like the privates market is. There's a ton of people transacting in it, not as prepared to do so. And so that's what I initially, as you noted, like initially I started building in the blog, like the LP Lessons blog, which was just a way to share literally lessons from one LP in an anonymous way with another LP so that people could learn from one another at scale. And then over time I launched, which you also mentioned, GP LP Match. Now we're about 18 months in, which is effectively a platform that helps GPs and LPs meet each other.
Oh, that's awesome. At Nectar, we talk to GPs and LPs all the time, and it is quite different from the institutional space. How was the transition and what are the biggest differences for you that you've, as a private LP, that's important when you're navigating the private market that's different from when you're an institutional LP or investing from an institutional perspective?
Maybe I'll start with what's not different because I think this might be interesting. Imperfect information is very much the same. So although you might think, oh, you're a public REIT, we had a lot of leverage, in our transactions because we were large and very well known. I think we could get away with asking a few extra questions, if you know what I mean. But I just want to be clear, like we still very much had to make investment decisions on imperfect information. And that's something that you very much have to train yourself to do over time. Another thing that was not different is the level of imperfection, if you will. This is like a little bit unique to our business that we were in, but we were in the business of buying buildings from lower middle market business owners. So, think about anything from like a pizza shop with a single husband and wife owner, all the way to maybe even like a KKR owned private equity firm. And so it wouldn't be so uncommon for us in diligence to get a balance sheet that doesn't balance, for example. And my initial response to that as an analyst was like, this is crazy. Like, how can we do business with someone who can't even get their balance sheet to balance? And over time, I learned that like that specific reason is why we're in business. Meaning lower middle market America doesn't have the perfect accounting systems, doesn't have the perfect CFO. Sometimes they don't even have a CFO. And nevertheless, that business is still making 1, 5, 10 million a year. And I realized very quickly, actually, that our job in the underwriting team is really to decipher between, in a sense, this sounds a little crazy, but it's like we have to decipher between the balance sheet that doesn't balance with a good company behind it, and balance sheet that doesn't balance with a bad company behind it. Even though at first in both of those cases, we got a balance sheet that didn't balance, right? And so that is very similar to the private space, because I'll be the first to tell you, I get, 5, 10 submissions at the end, GPLP match. Probably 25% of them, maybe more, have like pretty glaring mistakes on a deck, right? I think a very natural response from an LP is like, how can this guy make a mistake on something so basic? And to be clear, there's like some basis to that, right? Because you're sort of feeling each other out. But at the same time, like, you also have to recognize that it might be a 2-person team or maybe a 1-person team. And this person is trying to juggle putting something under contract, underwriting it, putting together a deck, getting it out in time, all while juggling the fact that he has to close or she has to close in 3 weeks or whatever the number is. The information is very much imperfect on the investment side. That was the first point. The second point is like on the diligence side, also, the information is also very much imperfect on both sides. In terms of what is not similar, I'll give you one, and I'm happy to give you dozens of others. But I think what shook me to my core almost, I mean, that sounds a little extreme, but I'm actually not exaggerating. I think it's like very unhealthy. And it was probably the biggest reason why I started GPLP Match was I sat in an institutional seat, right? So like I managed a 20-person team. And I was just like blessed with seeing billions of transactions in the course of like a 6-month period. Like, I mean, we saw so much stuff. We ended up buying $1 billion or $2 billion a year. But of course, that's only a fraction of what we underwrote and a fraction of what we saw, right? And so it's a very fortunate seat to be in, because you get so much stuff thrown at you and you can't buy all of it. So you have to be picky. And you're just like sitting there and you're like, well, let me just pick the best stuff. I think the biggest lesson from that is extremely valuable for an investor to see a bunch of stuff, a bunch of deals. And the only way to learn how to invest and decipher between great and mediocre is making sure that you're like the funnel of opportunities in your inbox is large enough. Otherwise, you'll just miss stuff. And when I got to like the privates market, I realized that literally the exact opposite happens with the average LP. Where, I mean, how do I say this? It's like, I mean, I wish I was exaggerating, but it's like literally, hey, like, you're a doctor, I'm a doctor, like, I'm investing in this deal. It's real estate, nothing can go wrong, come invest. And the guy, like, writes $1 million check. He's never seen any other deal. He's never looked at anything else. Or she, obviously, you get what I mean. And it's just like this almost blind trust in a similar profession, similar religion, similar club, similar, you can, keep going. But the concept is like the funnel of opportunities that LPs see versus what they invest in is tragically like probably an average of 2 to 1, meaning you see 2 deals and invest in one on average, meaning that's the average, but some people are literally investing in the only deal that they see. Whereas what I would see at store, probably like would invest 1 in 20 deals, 1 in 30 deals. And you have to keep in mind that like many deals wouldn't even end up on my desk, right? And so I don't see why that should be any different for an LP. And so that was sort of like the impetus for me to start GPLP Match, because I realized there's really no way for an LP to like plug into a feed almost, that sounds so like modern, but like a feed of deals given their criteria. And that's what got us started.
That's awesome. If you have an LP that's looking to invest their capital, they have some amount of money that we can invest in a few deals a year, 3-4 deals a year. How would you suggest that, of course, they should go to GPLP Match? How do they funnel and say, okay, well, like, what is above average and what is, this is risky, especially when you also say there might be some glaring issue or the balance sheet might not balance and it's still a good deal. So can you talk through like what is important to look at?
Yeah, obviously this is a long topic, but I'll start it like this. The first step is to be honest with yourself as to whether you have time or not. If you don't have time, and this is a controversial thing to say, I realize, but if you don't have time, I don't think you should be investing in alternatives, because it takes time. It's a thing that takes time, meaning it will take you time to like analyze, It'll take you time to understand. So you have to have enough comfortable at-risk capital on the side that you could comfortably lose and be okay. But you also need to have time. It's not just about the money. Assuming you have that, I think the next step is just recognizing that you don't need to invest now. What that should mean in your head is you should recognize that you probably need to have 20, 30, maybe 50 conversations before you invest in something. And those conversations will all dictate how you think about stuff. So really the only way to learn is by practicing, which is why I said, if you don't have time, bad idea, right? If you do have time, then what you start doing is you start speaking to different GPs, and you'll slowly but surely, every single person will start picking up on stuff. Like if your sample size is 1 of 1, and someone doesn't want to send you a model, I'll just as an example, you're just like, oh, maybe that's normal. Okay, like here's a check. Once your sample size is 50 conversations and 49 of those people were like, oh yeah, for sure, here's the model, and one person doesn't send you the model, you're just like, oh, that's actually kind of weird. Like, I don't know, like, I'm not sure why he thinks or she thinks it's so confidential, but it's pretty normal to get that. So I'm not sure why they didn't want to send it. Same thing about like track records, just picking up on sort of like exaggerations on a deck in terms of experience. You'll see many GPs that sort of exaggerate the experience that they have in terms of realized investments, prior experience levels. The way that I sort of described LP-GP relationships in the beginning is like you're sort of like dating for marriage, and everyone is on their best behavior in the beginning. So is it okay for someone, you're on a date, right? And someone slips and falls. Okay. Like, yeah, like people make mistakes on a deck. That's the corollary, right? But is it okay for them to tell you on their resume that they are 5 foot when they're actually 7 feet? Probably not, right? Like that's weird. Maybe that's a signal of more to come. And it's probably not the way you want to start a relationship. The only way for you to understand what is a slip and fall and what is 7 feet instead of 5 or whatever, and decipher between those in your head is just experience and time. Like you need to have a lot of conversations. What I always tell LPs on our platform is you should very comfortably have conversations and not think about conversations as committing to invest. And by the way, GPs know that, like they're in the business of finding capital and they know that they're competing against other people. So I think it's normal.
I want to talk a little bit about, you've called 2026 an inflection year where owners must transact, recapitalize, or restructure. If you're an LP sitting on dry powder or looking to invest, how should you think about the next 12 months?
For what it's worth, I think this year we've had a lot more like distressed opportunities come up on our platform. We've also had a lot of recaps. Meaning like an existing sponsor trying to recapitalize an existing deal, a sponsor buying a deal from a lender that got foreclosed on, for example. I personally think a lot of those opportunities are very interesting because the capital stack was just broken. And the question is, this is like the complicated question. It takes some sophistication to understand. Is it better now? Like, is it in a much healthier place with what I'm being presented? If it is, then perhaps it's a very compelling opportunity, right? It could be that it's also not, right? So again, it takes some time to like look at these opportunities and decipher between them. But there's just a million different examples of like 2008 happened, 2010, even some of my friends were like buying houses for like 20 grand in Phoenix or whatever, you know, or Columbus, you know, and they just completely crushed it. Now, in hindsight is always 2020. I don't think it's too much of an exaggeration to say that like commercial real estate, especially like retail deals, even though I think this broadly applies also, kind of just went through their own localized 2008. It's a little bit of an exaggeration, but not too much so, because all the capital stacks are broken. They need to get fixed one way or another. The question for an incoming investor is basically like, do I wait for the existing investors to get wiped out? That's unfortunately the case on many of them. Do I invest while they're in? Do I invest through the lender, you know, or whoever is buying through the lender? There's definitely a lot of opportunity in that sense. And I think there's a lot to do there.
Looking back in 08, you know, 08 happened, but then 2010, 11, 12, the bottom in a lot of markets was 2012, which was 4 years later. How do you see that? And then even after that, 13, 14, 15, you were buying properties at in 2015, I bought a property at $15,000 a door. That then later on went and traded for $133,000 a door. Now, 133 was too high, but but that's a long runway of depressed pricing. Do you have any thoughts on, is the distress window just opening? Is it have a long way to go? What are your thoughts on that?
I would probably categorize it as just opening, yeah. I would also just maybe preface by saying that I don't know what I'm talking about. When I left store in like 2022, like rates were going up. I figured, okay, like rates are going to go up. Like a lot of capital stacks are going to break. 2023, everything will get flushed out. 2024 will be, not back to normal, but like, all the broken stuff will get flushed out in the private world. And I was, I think at minimum 2 years wrong, at minimum, and probably likely 3 to 4. I think it's just the beginning of this reset. A lot of things are still kind of getting taken over by lenders. A lot of lenders don't want to recognize those losses because it will impact their other positions from an accounting perspective. I think, as you pointed out, we're probably in the first year of 2 to 3 years of this, is my guess. But a good time to start, at least looking and perusing what's out there.
So while you started and been working on GP LP match, what have been the biggest learnings in terms of what GPs are more successful and what GPs are less successful presenting themselves on your platform? Are there takeaways there from that perspective?
I'll tell you the most surprising thing. I mean, it's not that surprising because I used to be in the seat. One of GPs' biggest problems is like you're so close to the numbers and the underwriting and the model that you sometimes kind of just fail to zoom out and speak the language of an LP. So it is extremely common for me to get a deck, for example, that says nothing about like the GP's experience. Sometimes it says nothing about them as a team, why this is a transaction that like they like, why it stands out. I mean, it's just like, it just goes so straight into like, here's the comps, here's the map, and here's like the surrounding cool retail shops or whatever. And it's like a fast growing area. And it's like, okay, cool. But like, why you? How did you find this deal? Like, what's the story? Right. So I actually think that's the story is often, especially for like retail. And I in many ways, I think for family offices and allocators is really what matters. Deals are deals, but every deal sort of has a story connected to it.
Just looking at my notes here, you're a self-described quant who's now looked at thousands of deals through your platform. It's hard to leave a podcast like this without talking about AI. So where in your mind does AI genuinely make an LP a sharper decision maker or fit into the investment process?
I think we're like at the early innings of this. To be totally blunt, I think a lot of the stuff that you see on LinkedIn is like very overblown, or Twitter even. Meaning there's just a lot of overstatements on what's possible, and I think people tend to overstate like what AI can do as of this moment. Having said that, I'll just give a few examples. I think preliminary reviews using AI are extremely helpful, but they can only be helpful if you have a lot of deal flow. Meaning, when you have a very large funnel, having AI summarize that funnel or compare the deals in some sense, basically getting you from, let's call it 100 deals to maybe 10 deals or 5 deals even for you to look at based on your own criteria, that's pretty good, right? That part I think is pretty well developed in terms of AI. The step that I think is overblown a bit is like, how do you get from 5 to 1? I think the reason why it's overblown is just from my experience, like AI will do something crazy, very impressive. And then in the next comment or the same comment, it'll say something that is a complete hallucination. Like the data didn't exist. You don't even know where it found it, but it always sounds so confident that like I just don't know how to deal with this yet. Personally, I'm struggling with it. It's like you want to trust it, but you also want it to just state when it doesn't know something. And I have not found a good solution to that yet, other than like checking their work. Maybe that's not so different against what you would have done with an analyst or something like that. typically an analyst will help you to go from 100 deals to 5. They'll write investment memos on 5, and then to go to investment committee, so to speak, so that you can decide on 1 or 2 of those 5. I don't think AI is anywhere near the capabilities of like making those decisions, but maybe we'll be there. I mean, things are obviously growing very fast, and I've been pretty impressed for what it's worth.
To talk a little bit more about, on you and what you're working on with kind of LP lessons and GP match, where do you see that this is going? Where are you working on now? What are you most excited about in the work that you're doing today?
I think the biggest focus is, in a sense, it's education. I want to give LPs the ability to have better choices. The struggles, I'll share some of the struggles, is like, I think initially I released GP-LP match for retail, actually based off of what we all spoke about in the beginning, where like people just invest in the first deal that they see and they don't realize that there's more. The problem is the same person that invests in their, friend's deal when it's the only one that they see doesn't really know how to decipher between deal 1 and deal 50. And those are pretty difficult users for us to have, right? Because we send a lot of deals, you have to understand how to decipher between them. And you have to at least have some capability of thinking about yourself as sort of like an investment manager almost, right? So like family offices and allocators have loved the platform, but they're just built different than a typical dentist or a registered nurse or business owner. They're just different in terms of acumen as far as investments go. So I think that's one thing that we're thinking a lot about, is like, how do we cater to the different types of LPs that are on the platform? I think another big goal is just expansion. I mean, as of right now, we haven't paid like $1 in advertising. Bootstrapped company, so that's one of the reasons. Just trying to keep up with payroll and making sure that everyone gets paid. 18 months in, I think the platform and the app is getting to the point that's like, we're just at the cusp of being able to scale basically pretty effortlessly. And that's pretty exciting. In my head, I think we're getting close to 3,000 LPs, which is really exciting on the one hand, but it's also nowhere near where I thought I would be by now, which tells you 2 things. One is that it's extremely difficult to find LPs that are active. 2, we have a lot of work to do. I would like to be at 50,000, 100,000 LPs, and there's really zero reason why we can't be, other than focusing on growth, which to date has just been purely organic.
In order to be most attractive to LPs on your platform and get more active people there, what should GPs bring to the platform that would be most exciting and most interesting to your network? We have a ton of GPs in our network, and if I'm giving them advice as to when to come to GP-LP match, what would I say? And then same for LPs. When should they say, hey, I'll go to GP-LP match? Like, what are they looking for where that's where they need to go?
It's kind of a multifaceted question. I guess I'll give you the simple answer, and then I'll give you a more complex one if we have the time. Like the simple answer is when you raise money, right? I mean, like that's basically what we help with. You submit a deck. It's like a pretty effortless 2-3 minute process. And as you mentioned in the beginning, the LP matching engine is entirely free. The more complicated answer, and actually it's a question I get a lot. I already have LPs. Like, why would I come on your platform? I just have a deal right now. I can just capitalize it with my own relationships. Like, why squeeze my own relationships in terms of allocations for the benefit of perhaps someone I don't even know. I don't want to take a random investor from some GP-LP match portal, right? And so I just try to remind people of 2 things. And I guess there's some bias. People can ignore it if they'd like. But the first thing I'd say is like, your existing LPs are amazing until one of 2 things happen. You grow out of them, or they're no longer liquid, right? Meaning the first one means you just might be doing too many deals to capitalize with your existing LP base. And then all of a sudden you wake up to a problem that you don't have time to solve. The second piece was they're just illiquid. So you might have a phenomenal base of LPs, but when you need them, they don't need you, and that becomes a problem too, right? So really the only reason to get on GP-LP match, according to that, is just slowly diversify your base And what I like to tell people is like, don't crowd out your existing investors. Like leave 20%, 30%, whatever it is for other folks. If you meet some great people, wonderful. If you don't, so just capitalize with your own base, right? So that's really the way that I would think about it.
Is there a piece of wisdom that you give to LPs that are they're seeing the deal flow, they see that there's some distress in the market, they've looked at a couple of deals, but they're retail, they don't have an investment management background? How do you narrow it down to these are the deals where we're to focus on allocating?
I think again, it's sort of like time and education. The only reason to be on GP/LP match is it's top of funnel, but I would describe it as a lot more than that in the sense that it's extremely educational. And some LPs have reached out and they're like, hey, I'm expecting my bonus in 6 months. So like, maybe it doesn't make sense for me to be on. I'll register in 6 months. And I'm just like, you're literally thinking about this backwards. If you're expecting to invest in 6 months for the first time, you should have been a member 6 months ago. The best time to slowly learn is actually when you don't have money like burning a hole in your pocket, because you can be more patient, you can learn. And we see this with LPs all the time. Like they'll register, they'll start with like a very wide aperture in terms of their mandate. They might say like, send me anything. And I'll send them 5 deals a day and they're just going to be like, like I didn't mean like anything. Like don't send me deals in Texas, or don't send me development because I just don't understand it. Or like, I don't want to do anything in New York or California or whatever. And by the way, like for every single person, that moment is extremely good. Like that is basically your response to like what you're comfortable with and what you're not. So then you slowly refine your mandate, and then you start selecting. You go from 100 to 20 to 10 to 5 deals, and then it becomes like a lot more digestible. I think it's really like the first thing you should do is just like figure out like what interests you the most in terms of like geographies, property types, risk categories. Do you want to invest in funds or single asset deals? Right? Like all this stuff. The only way you can figure that out is just looking at a bunch of decks, unless you sort of just like blindly trust someone who does it for you or whatever.
Well, this has been incredibly insightful. Thank you for taking the time, Aleksey. It's been super helpful. Any last words, or where can people find you if they want to learn more?
My email is just Aleksey, Aleksey at gplpmatch.com. And yeah, I'm pretty active on like LinkedIn and Twitter for the folks that waste too much time on those platforms. I'm right there with you. And yeah, just reach out. I'm like pretty easy to find.
Awesome. Thanks for the time.
And thank you for listening to the Real Asset Intelligence Podcast. Find out more at usenectar.com.